We will wait for just 5 minutes because students must be joining in. Yeah. Prathamesh, I think we can start the session. The students will be joining in. Okay, sir?
Sure, sir.
Yeah, sure. We can start.
Yeah.
A very good evening to one and all. Hope you're all safe and are flourishing well at your respective internships. I, Prathamesh Rege, would like to take this opportunity to welcome all the students of weschool and our respected faculty members attending the session today. Thank you all for joining us on a Friday evening for what we know is going to be a great learning session for everyone. The topic of today's session is the world of venture capital funding. And it is my privilege to introduce and welcome our very special guest speaker for the day, Dr. Farzan Ghadially. Dr. Farzan Ghadially is the Senator India for the World Business Angel Forum, WBAF, an affiliated partner of the G20 Global Partnership for Financial Inclusion. As a senator, his role includes helping startups and early stage companies along with SMEs to rise to a global scale, leveraging the WBAF network across 111 countries around the globe. He is also a mentor with the Untitled Incubation Center, a leading incubation center supported by the Government of India. He is also on the mentor board of the Incubation Center at IIM Sirmaur. By profession, he is an investment banker and heads a multi-family office. He has rich experience in the financial services industry in India and overseas. He is a member of the prestigious MDRT Million Dollar Roundtable Club and has been a top of the table TOT and court of the table TOT, two of the highest accolades for financial advisors. He has been a speaker at many international and national conferences on personal finance, private equity, and family office. He is the author of 2 books, Investing in Turbulent Times and Investing in the Turbulent Decade That Was and Beyond. He writes in leading financial newspapers, including the very famous Midday, where his column features every Monday in the finance section. He is a visiting faculty in leading management colleges like SP Jain, NMIMS, and our very own weschool, amongst others. He is the chair for innovation and entrepreneurship, as well as special projects at Young Indians as a part of CII. He works closely with corporates on fundraising, fund management, and monitoring, as well as investor relationship. I'm sure that all of us are eagerly waiting to hear from you, sir, our esteemed speaker today. So without any further ado, I would like to invite Dr. Farzan Ghadially to commence with the session. Over to you, sir.
Thank you. Thank you so much for a wonderful welcome. Welcome to all of you guys on a Friday evening. And what we are going to cover today is the world of venture capital. When we talk about the world of venture capital, we are really looking at a different perspective. We are looking at a new India, an India where we are seeing startups really flourish. What have we seen in the last 1 year? In the last 1 year, we've really seen about 44 unicorns that have really been formed. I mean, just to get the basis right, a company becomes a unicorn when the valuation, when the valuation goes to $1 billion. $1 billion is a lot of valuation that is really there. Today, India has over 100 unicorns, about 101 unicorns, and it's growing. It is estimated that probably by 2025, we would have about 250 unicorns, making India really the unicorn capital of the world. So what is happening is there was a time where the startup ecosystem was there in India, and there was not a lot of concentration as far as the startup ecosystem was there. Today, the startup ecosystem is really a force to reckon with. We have 100 unicorns already. They have attracted billions and billions of dollars that are there into the country, created a lot of opportunity, created a lot of innovation. So they're doing something right. There was a time when age-old businesses or old-fashioned businesses would always say that these unicorns will not really last, or these startup companies will not really last. But they have stood the test of time. Certain startups have really taken on the larger companies. So today, as young budding professionals in the near future, as management students, when you all are really moving out in the real world, it's not only about acquiring or getting into a job. Probably some of you all have an idea. Some of you all really feel that you will have some kind of innovation that you could probably make a difference to, and you could create probably $1 billion enterprise. What used to take about 25, 30 years to create, today is created in 2 to 3 years. So what is important is today in this session that what we will do is we'll really try and cover that what are the nuances, how is the startup ecosystem there in India, what are the participants in it, what do they do right? Because there are 2 parallel worlds that are really existing in India. Today we have the small and medium enterprises, or the SME companies as we call it, that struggle to raise a few lakh of rupees. You go to the bank, you try to raise a few lakh of rupees, you need a collateral, you don't have a collateral, and these companies are really struggling. And here are these unicorns that are probably just 1, 2, 3 years into business, and they're raising millions and millions of dollars. So it's not about what is the right form of doing business. It's about understanding what do really investors look for, what are they really looking for, what should you as budding entrepreneurs really look for, and most important, is it possible? Is it possible that for you to really have a next unicorn? So if you really look at any business, or you look at any business that is there, It's all about capital. It's about the amount of capital that you can draw to really fund your business. Now, when you're really looking at drawing capital, there are various forms of capitals you can really draw. Earlier, what used to really happen is basically you start a small business, you acquire a certain business or start a business, you put in some capital of your own, you put in capital from friends and family. That was the first stage. Then you typically go to a bank. So when you go to a bank in this country, what really happens is the bank will always look at what collateral can you offer. So if I want X amount of money, do I have that kind of collateral? If you offer that collateral, probably you're given that loan, and then you slowly keep growing your business. So this transition that was really there was slow and steady. It was a profitable transition that was really there. So at every year, quarter after quarter, month after month, you make some amount of profit. Keep investing that back into the business and keep growing slowly and steadily. So probably you do 1 crore on the first year, then slowly go to 3 crores, then 5 crores, 7 crores. So by the time you come to approximately 50, 60 crores, you already invested 10, 15 years into the business, and you're really continuing to do business. That is the age-old way of really looking at it. Today, what is happening is there is a revelation in which capital is really raised. What people are doing is people are coming up with disruptive ideas. When I say disruptive ideas, ideas which will give a solution to a problem that really exists. When I say solution to a problem that really exists, is let's look at some of the unicorns that have really been formed. If you look at the typical model of the cab aggregation or car aggregation model, what is the model? Today, every one of us had a problem a few years back. For all the people that have been in Mumbai for about 15, 20 years, the biggest problem that was earlier there was you go down your house or go down your office, wait for a cab. You had to wait 15, 20 minutes for a cab to come. There was no taxis available, probably at peak hours, and you never got a taxi. So there came in a solution. A company called Uber comes in and they say, what do? They aggregate. They give you an app in which they really say that, listen, it's a demand and supply. So here are the people that have the cars and here are the people that want to ride. Let's aggregate the information on the app. Let these match and we will make some revenue out of it. If you really look at it, what does Uber do? It gives a technology solution. Does it own any cab? It owns no cab. Does it own any offices that are really there? It doesn't. So it is an absolutely capital light model that you're giving a solution to. When you're giving that solution, you can really scale it up. Now let's look at it the other way around. When you look at the cab aggregation model today, if we know that there is a gap in the market, we would probably go and buy 2 cabs, 3 cabs, 5 cabs, 10 cabs, or probably 100 cabs, beyond which we wouldn't have capacity. And slowly, as business increases from those 10 cabs to 100 cabs to 300 cabs, that's how you keep growing. But here is a model wherein it is aggregation on the app that is there. So you can scale from 100 cabs to about 2,000 cabs within probably a couple of days because you do not really invest in capital expenditure. So what is important for everyone to understand is this capital expenditure that was the biggest deterrent that was there a few years ago is no longer there. It's your capital expenditure is not really required. Whatever is required is your operating expenditure. Let's look at it this way. Let's look at the hotel industry. What was the earlier hotel industry? You had the Marriotts of the world, you had the Hiltons of the world, you had the Holiday Inns of the world. What did they start with? They started with a couple of properties of their own. Over a period of time, they expanded internationally. Then they really got into management tie-ups with property owners. So if I in Mumbai today, I had a property which I really wanted to set up a hotel. I approach one of these companies, say Hilton or a Marriott. They take it up as a management contract. I give a certain percentage to them, but the capital is invested still by me. Hundreds of crores have been invested. There comes in the model of Airbnb, which really says that, listen, we are not going to build any hotel. We are not going to own any hotel. We are not going to spend anything on capital expenditure. Here are people that want to rent out their houses. Here are people that want to rent out the extra space that is there. We will put it on an app, and here is an international audience that wants to travel to that location. They find it on the app. So what is it that really basically that is owned as far as Airbnb is concerned? 0 rooms owned. But when you look at it, the amount of scalability that is there in these businesses is humongously high. Today, they can move from one city to another city very, very fast because they don't have to spend anything in terms of capital expenditure. Yes, they have to probably upgrade some part of the IT, some part of really the systems and processes. However, the cost is really incremental or marginal compared to actually putting up an actual capital expenditure in terms of a property. Let's look at other examples. If you really look at today, if you really look at the Zomato example that is there, the Swiggy and the Zomato, do they own any restaurants? Okay, do they own any of the bikes that really deliver? None. They don't own a restaurant. They don't own the bikes on which these deliveries are done. The employees that come to deliver, they are not on their payroll. So what are they doing? They really are doing a gig model in which there was always a restaurant where people wanted to order food from. The restaurant probably never gave delivery of that food. There were always people looking for jobs. They put them together saying that, listen, you go once the order is placed on the app, the person goes, really takes the food and delivers it. Again, no capital expenditure. Now, when you really look at these models, we have to really look at market capitalization. There has been a lot of criticism of late that some of these startup companies have not done well, or probably once they listed, the startup companies have crashed in terms of really Paytm and various examples. Well, my friends, let me tell you, okay, Infosys is one example. Infosys is probably one of the best IT companies in the world, and undoubtedly the best IT company, one of the best IT companies in India. It took Infosys 13 years to come to a market capitalization of 1 lakh crores. 13 years. It took 13 years for it to reach 1 lakh crores. These startup companies like Nykaa, Paytm that are really listed, Zomato that is listed, reached 1 lakh crores on the day of listing, 1 lakh crore and above on day of listing. So the way investors and the way the world looks at things has really changed. So there was a time wherein you had to go and create an asset. You had to use that asset, go create a loan, and really go about and really make profits. Things have changed. There is no capital expenditure that is really required. Everything is tech enabled. So if you see the theme that is really underlying, whether it is edtech, whether it is fintech, whether it is a delivery platform, the technology theme is very strong. India has always been known as the consumption capital of the world. You name the brand in the world and they want to have presence in India. Why is that the case? The case is because we are blessed with a very good young growing population. A population that wants to move from the tier 2, tier 3 cities to tier 1 cities. A fast pace of urbanization that is really happening. Keeping this in perspective, every multinational wants to come to India to witness this consumption story. We are undoubtedly the best consumption story in the world because we are a stable democracy, we have a stable government, we are not China. Okay, so all of those factors makes India a very lucrative place to really be in. So when you really look at this, when you really look at it, what is the way to really prevalent and really spread across in India? Technology is really the platform. Today, when we really look at it, today every corner of India is covered by 4G technology. There may not be a post office or a bank branch in a village, but under the banyan tree, you will have a person sitting on 4G technology. What does he have access to? He has access to probably the Amazons of the world. He has access to the net. He has access to really online ordering platforms. So that really shows that, due to this technology prevalence that is there in India, anything that you're really looking at doing in terms of technology will really do well as far as the Indian theme is really concerned. Now, when you really look at it as perspective, the first thing that really challenges a lot of these startup models, each one of y'all, if you really look at it, if y'all ask a generation above, that what's the motto or what's the aim of doing business? That's the first question. That listen, why are we doing business? That why are we here to do business? The answer is to make profits. That's the obvious answer. Today, each one of us is putting efforts of trying to do business to make profit. Profit can be small or it can be large, but each one is really trying to make profit. However, what is it these startups are really doing? These startups are not making profits. They're losing money month after month, quarter after quarter, year after year. But only thing that they're gaining is if they are gaining market share or they're growing in sales. So basically what is happening, the top line of the sales is increasing, profitability is not increasing. So if you go by the conventional sense of doing business, is absolutely a no-no, because you cannot really do business at a loss. If you're doing business at a loss, shut it down. What was the age-old principle that was used in India? The age-old principle is 1,000 days. You start a business, if it is not really profitable in 3 years, you shut it down. But today, if you really look at startups, what are they doing? They are not profitable for not 3 years, for many years to come. But what are they really looking at? What are they looking at? They are eventually looking at a market share. They are looking at probably a thing that over a period of time, as market share increases, one day profitability really will come. So that is something that is different. So when you are looking at starting a company, or when you're looking at the startup ecosystem in India, the first mindset change that is difficult to get is profitability is not the right index. What is the right index is really your sales or market share. In the investment banking and the funding industry, there is a term that has been used over the last couple of weeks. It's called the funding winter. Okay, what is the funding winter? That a lot of these venture capitalists that went to fund millions of dollars to these companies are telling these guys that, listen, slowly get profitable. So things are gradually probably changing, but the aim is to really get market share that is really there. So the whole concept of becoming profitable should be really, you should really be nothing should be really be taken out. That is extremely important to understand. Now, when you are looking at this, that you're building an enterprise, what are you really building? You are building an enterprise wherein market share is important. You're growing over a period of time, and eventually you will get profitable. That is the premise you should really look at. So if some of y'all have any idea of y'all really feel that there is some kind of disruption that is really there, it is extremely important to really understand what is your responsibility. A lot of people will really say that I'm a marketing student, I'm an HR student, I'm a system student, I don't understand finance. It happens, right? After my MBA specialization, if I'm a marketing student, I would love to go to a probably HUL and get a job, or Britannia and get a job and really grow my thing in terms of marketing. But if you are doing a startup, what is your responsibility really, as far as a promoter, as far as the owner is concerned? Capital, extremely important. Your responsibility will have to really be raising capital, because that is the single largest point that is important in terms of your success of your startup. So you as young management students cannot say, if you all are going to start something, that listen, I don't understand finance. If you don't understand finance, you will have to have a co-partner or a co-promoter that probably understands finance, because at the end of it, it's extremely important that you need to raise capital. How do you raise capital? What is it? How is it? That's the premise that is really there. It's like as simple as that. It's like, you have an EV car, electric vehicle. It rides beautifully. It drives very well, only till the time the charge in the car is there. So the charge in the car is your capital. Your startup will only do well till the time you have capital. Once you really don't have capital, there is a problem that is there. Now, how is it different from really the conventional businesses that are really there? If you really look at conventional businesses, after 2 years, 3 years, or 5 years, what really happens is you can probably go to a bank. You go to a bank and probably get a loan, because you have a track record of 2, 3, 5 years, and then probably you get some amount of loan. However, in case of a startup, that will not really happen. Why will that not really happen? For a simple reason. Banks will again say, where is the collateral? And you don't really have a collateral, because your premise of doing a startup is, I am less capital intensive. I don't have a capex model. So you will have an office that will be rented. You will have probably a godown that you work in that will be rented. Everything will be leased. So there is no asset that is there. So what is important is you will have to keep really raising money that over a period of time. Now, when you keep raising money over a period of time, it's extremely important that in these challenging times, there will be ups and downs in the economy that is really there. What is happening in the economy today? We've had the most fabulous 3 years in the capital market that has ever witnessed. Starting with 2019 was a good year. 2020 till March was one part of the year. Then COVID struck. People did not really realize in COVID period, what is it, how bad is COVID going to be there. So what happens, central banks around the world started reducing interest rates, started injecting liquidity. There was a lot done even in India in terms of by the RBI and the central government. What did RBI do? They gave you COVID loans, they gave you contingency lines, they gave you moratorium. So there was a lot of liquidity that was pumped into the economy. A lot of liquidity was pumped into the economy so that the sectors that are affected really keep consuming, people keep consuming. So we had 2019 that was decent, 2021 was excellent. So 3 years we've had the most fabulous capital markets that are really there. Coming 2022, what is important to understand, the biggest problem that we are facing is the problem of inflation. What is the problem of inflation? As we said, महंगाई बहुत ज़्यादा हो रही है. You look at the United States at an inflation of 8%. They have the highest inflation in 4 decades. So what is the mandate of the government? Remember one thing, there are only 3 to 5% of the people that put money in the capital market, whether it's a stock market or whether it's private investment. But 100% of the people get affected by really the price rise that is really there. So central banks around the world, including India, have started increasing the interest rates. So there was a time last year where you could get a home loan in India for 6%. That was the cheapest and the lowest interest rate ever in the history of this country. You could never get a home loan at 6%, but that was absolutely possible. A home loan at 6% and the car loan at 7.5%. Now what is happening, because inflation around the world and India has started picking up, we've started increasing the rates. The central bank is really started increasing the rates. When they've started increasing the rates, they have shrunk the amount of liquidity that is there really in the capital markets. What is important to understand, what moves the stock market? It is not really fundamentals that move the stock market. It's liquidity that moves the stock market. So there was abundant liquidity that was generated in 2 years of COVID period because of the push of central bank. And suddenly because of the inflation, now central banks are absorbing some bit of this liquidity. So there has been a meltdown in terms of the listed market. Now, when there's a meltdown in terms of the listed market is a benchmark to early stage companies. So today, if I am going to really raise money as far as private equity or venture capital is concerned, they will benchmark it against listed companies. But when the listed companies themselves have come down, the valuation of these companies have really come down. So today, what has happened is in 2022, as we speak, as we do this webinar, raising capital has become very challenging. Raising capital has become challenging because the central bank and the government is not interested to satisfy you and me raising capital. What are they interested in? They are interested in single point agenda at this juncture to control price rise, because price rise affects the common man. That is extremely important. So in the next 18 months that we really see, there is going to be swift action by RBI in next 2, 3, 4 quarters, where they keep rising the interest rate. When interest rate rises, what has happened? Who were the people that put money in the stock market? In the present run, who were the people that put money in the stock market? Foreign portfolio investors have always been a force in the Indian stock market. It was small retail investors, probably sitting at home doing nothing. They decided they'll put some money in the stock market. How much did they put? They put very little. They put 30,000, 40,000. What were the number of demat accounts that were really open? 4 crore demat accounts were open. So you put the math together, 4 crore into 40,000. That's a lot of money. That's almost 200,000 lakh crores that were invested in the market. A lot of money has been channelized into the markets, listed markets, venture capital markets. So there has been a gush of liquidity that Indian markets also witnessed, which slowly seems to be drying. It really seems to be really drying out. Now, when you really look at early stage companies, you look at a profit and loss, a balance sheet, and your cash flow. Now let's understand this. I mean, I'll just run through it in just a couple of minutes for a simple reason. It's extremely important to understand. Is it important to do business in profit? Probably answer is yes. Is it important to have be cash flow positive? It is even more important. So if I am selling some goods, say if I'm selling something at say 1,000 rupees and I'm making 20%, but I'm realizing this money 20% after probably 3 months, for 90 days, I don't have this money. After 90 days is when I'm realizing this money. What happens then? Really, I run out of cash flow because I have to give salaries the next month. I have to pay my rent for my office the next month. How am I going to really look at it? So when you are an early stage promoter, what is the focus? The focus could be marginal profitability. Don't do business in a loss. That's fair enough. But you will have to really look at cash flow. So if you're given two scenarios, one scenario wherein say you have to sell something for 1,000 rupees and make 20%, you're making your 20%, or probably, and realizing money after 90 days is one option, or probably saying that, listen, I will do the same thing, but I will not make 20%, I will make 5%, but I realize the money today. If you realize the money today, you will be able to circulate the cash that is really there as far as your early stage company is concerned. Always remember the velocity of rotation in the early stage company is very important. What do I mean by velocity of rotation? If I make 5% of say margin, or say if I'm just making 5%, not every 100 rupees I'm making 5 rupees. But if I am doing that every 15 days, how many times am I circulating that money through the year is important. But if I'm making 20% margin, it appears a nice and lofty margin that, wow, I'm making 20% margin. But I'm realizing money after 90 days. If I'm going to realize money after 90 days, I'm just going to rotate it 4 times a year. So do you want to make 20 into 4, or that is 80 rupees at the profit at the end of the year and probably not have a survival of business? Or do you want to make 5 rupees and do it probably 10 or 20 times you rotate this amount of capital? So what is important for any early stage company that is there? Please open up your cash flow statement. What is important is not profitability, is cash flow. When you get the money is more important than how much profit that you really make. It is important to make profit. Okay, it's important to make profit, but when you realize the money, because the moment you run out of cash flow, you can't go to your employee and say that, listen, I'll pay you after 90 days. You can't go to your landlord and say that, listen, I'll pay rent after 90 days. It will not work. You will not really survive. So this dependency on cash flow is something that is extremely important. So when you are an early stage company, always focus on your cash flow. How are you going to really look at it? And really look at it as the velocity of rotation. How many times are you going to rotate this capital? The more you rotate the capital, the better it is, healthier it is. A lot of times people, really ask me that, listen, how can you really do business at 5% and 4%? Doesn't matter. It doesn't really matter. If your velocity of rotation that is very high, you look at a big trading company. Let's go back to old age conventional businesses. Look at a trading company. When you look at a trading company, they probably do 2,000, 3,000 crores in turnover. How much do they make? They make 2% margin. But why are they doing 2,000 crores in turnover? They're doing 2,000 crores in turnover because their velocity is extremely important. So when you look at a startup, your mindset needs to change. It's very important. Please look at your cash flow. That is extremely important. Some of you folks that are in management are maybe from engineering background and must be thinking that, we don't understand P&L. How are we going to understand cash flow is a question that a lot of you all may have. Very simple, my friends. Cash flow is simple as that. You sell something today. When will you realize the money? Look at it as a crude method, as an engineer's method of really looking at it. I made a sale today. Now, from the day I make the sale to when I realize when my money will come into my bank account, what do I have to pay? How will I manage that? That is something that you have to really look at it. If it is manageable, your positive cash flow. If you're non-manageable, it becomes a negative cash flow. Businesses around the world, large or small, that have failed because of cash flow. The first sign that you will have stress in your business is a cash flow mismatch that you will have. You realize that, listen, I don't have money. I don't have money to pay. That is the first sign where you really look at it. So when you are starting small, cash flow is the key. How do you maintain cash flow? Basically, how are you? You will have to put some amount of capital of yours. I mean, it could be a few thousands, it could be a few lakhs, it could be a few crores. Doesn't matter. What is important is how are you monitoring your cash flow. So the way you look at a startup is very different than way you look at an SME. If some of you all are from business families or business backgrounds, the way you assess a family business or a SME is very different to a startup. First difference, most important, in a family business or SME company, what are you looking at? You're looking at profitability. Business karo, dhanda karo, to profit ke liye karo. In a startup, when you're really looking at a startup, what are you really looking at? You're looking at sales and top line growth. Loss, no problem, do the loss. As long as you have some business plan that one fine day, eventually you will make money so that you get enough of market share. That's the first difference. Second is, as I said, profitability versus cash flow. You will have to look at a startup company completely in terms of cash flow rather than profitability. Doesn't matter that it looks very cool and nice that I'm making 20%, 30% margin. But if you don't have the cash flow, you will not survive. And if you don't survive, you shut down. A lot of times people say survival rate of startups is only 20%. Why is survival rate of startups 20%? Because of a cash flow mismatch. Because they're unable to really match as far as the cash flow is really concerned. So when that happens, the mortality, as we call it, is very, very it's extremely high. Now, when you really look at your journey as a unicorn, each one of us, would feel that, listen, what is a unicorn? Now, when you say valuation is $1 billion, when you look at a valuation as $1 billion, are you getting $1 billion? Are you getting, if you look at $1 billion multiplied with a dollar rate today, okay, it's a lot of money. It's 7,000. It's almost 7,700 crores plus. So it's not that you are getting 7,700 really crores. What are you getting is the value of the business. Let's take a simple example. Today, if I start a company, if I start a company that is probably, let's look at it. If I start a company giving education, ed tech company, and y'all are all students that come to learn from me. What is my revenue model? The fees or the subscription that you pay me. That is my revenue model. Now I go to an investor and say that, listen, here are people, say about there are 60 odd people on this webinar. Each one has paid me ₹1 lakh. 60 lakh rupees is my revenue. That is really coming. And I do X number of webinars a year. So this is the revenue model that I have. That's a revenue model. Now I will have to value my company. When I value my company, I will tell him that, listen, why don't you put in some amount of capital which will give you a percentage of equity in my company? Now, when you value a company, I will say, I want to value my company at 100 crores. What does 100 crores mean? 100 crores is really your enterprise valuation. Valuation of your complete company is 100 crores. Now, if this gentleman or the investor is putting 10 crores, he gets 10% of the company. So when we look at this word of unicorn, please bear in mind the valuation is reached $1 billion. It's not they have raised $1 billion. They could have raised probably even 100 crores. But if you're valuing the business at $1 billion, $1 billion is what a unicorn is. That is really there. Now, important is which are the companies that have really become unicorns. Okay, it's extremely important to understand. One, as a promoter or probably as a startup, do you really believe in your idea, service, or product? You will have to really find a problem in the market that exists, a problem that a large number of people really have. The examples that I gave you when I started the webinar, okay, Airbnb, okay, if you look at Zomato, if you look at Swiggy, these were real life examples that were really there. These were gaps in the market. We all like to eat. We wanted to order, but we couldn't order because probably that restaurant did not deliver. So there was a gap in the market that was there. You look at Uber. If you really look at Uber, what was the gap in the market? Again, as I said, we wouldn't find cabs. The convenience that it is really giving you. So these were all gaps in the market that were identified. So first, what you need to understand is, please, whenever you're starting up a startup company, it's not about just starting a startup company. It's what's the gap you are identifying. Is there a gap? Is there a problem? A, B, is there a solution to that? If there is a solution to that, is it a solution that can be mapped across very fast? I mean, it's not a one-on-one solution. Is it a solution that I can give you that can be mapped very fast across? Now let's go back. If you really look at the app we are using, Zoom. The Zoom was a typical example. How many people use Zoom before March of 2020? Hardly. Over a period of time, what really happened is a lot of people started using Zoom because we were forced to use Zoom. Why were we forced to use Zoom? We were forced to use Zoom for a simple reason, because we were all in a lockdown. So scalability is very, very fast. So there were audiences, thousands and lakhs and crores of audiences that wanted to communicate with each other, maybe for pleasure, maybe for business, maybe for education, whatever be the case, people came to the app. So scalability has to be very, very fast. So first, is there a gap you have identified? Is there a scalability that is really, really there? That's extremely important. What is important is now when you're really looking at a startup is you will have to really follow a few steps, as they call it. First, you will have to look at fundraising. Why would you have to look at why would you look at fundraising? You would look at fundraising for a simple reason: cash flow. Where will you get the money from? You really need to augment that amount of capital. So you need to really raise that amount of capital. So what's the first step? You fundraise. What's the second step? You raise even more money. What's the third step? You raise even more money. So you keep raising capital every round to really complement that is really, really there. A small little thing that people should really remember is when you are really, a question that often comes: should founders or probably startup people take a salary or take some kind of remuneration? It's not a bad idea, guys. Remember one thing: when you meet an investor and say that, listen, I don't take any money from the startup. I am not taking any salary. I mean, it can't happen, right? You don't survive on air. There is some amount of money that you require for basic needs for a family to really go about. So taking some amount of capital or taking some amount of salary from your startup, not a bad idea at all. I mean, be practical. I have met startups that have said that, listen, I take about 50,000 or lakh of rupees a month because I fend a family. Is that acceptable? Absolutely acceptable. Is it acceptable that the startup, probably the promoter takes about 20-30 lakh rupees a month from that startup and he takes 2-3 crores out? Absolutely not acceptable. So it's a relative thing. As long as it's reasonable, there is no issue at all. Just to quickly run you through management students through the landscape really of the business, the forms of business that we really have. We have a sole proprietorship, easiest form of business. It's not a separate legal entity. It is the same as you as a person. You start a sole proprietorship. You need a trade. You really need a trade name. You can have a trade name and you start it across, and you can open a bank account and conduct business. Then you have a partnership concern, the most common form of business in this country. As the name suggests, 2 or more people come together and really form a partnership concern and do business. Then you have a limited liability partnership. Similar as a partnership concern, liability is limited. Then you have what is known as your company, private limited or public limited company. All you folks that are going to raise money or with the aim that I'm going to raise money in the future have to get into a private limited company. The disadvantage is only compliance and the cost of compliance. There is a cost of doing business. There's a cost of compliance that is really, really there. So there has to be a cost that is there, but that's the only form in which you will really, raise money that is really there. When you really look at, when you really look at your value chain as far as your cash flow is really concerned, you will have to do a few things and not do a few things. Is one, be very, very clear that the aim is to grow the business. A lot of times what happens is when business starts growing, people get ideas. What are the ideas? I will sell my products to my sister concern or my group company. I will do very little profits here. Maximum profit I will retain in my group company. I will take the investment in the main company. Won't work. You will have to really be transparent, and you will have to really do it in a way where the investor is rewarded and you are rewarded to the maximum. You will have to do optimization of capital and give the maximum remuneration or maximum return to your investors in the best possible way. As I said, I've already covered this. You really have capital broadly. You can have capital into 2 parts: your debt and your equity on the startup space. You will only have in terms of equity. You have a few what is known as venture debt funds that have come on the debt side of it. So what are venture debt funds? Venture debt funds are funds wherein they will give you a loan to companies that have been funded by venture capitalists already. So these are venture debt funds. When you have venture debt funds, the advantage is every time you raise equity, you have to give some percentage of your shareholding. So when you keep giving some percentage of shareholding, you can become a very little shareholder in your own company. Advantage of debt is you take this amount of money, pay it back, so you don't really dilute that. You don't really dilute that kind of equity that is really there. Now, when you're really really looking at it, when you're really looking at this, what does it investment depends upon what? As I said, one extremely important macroeconomic factors that are really there. When I say macroeconomic factors, I touched upon this, that we've had fabulous 3 years. 2022 looks a little challenging year in terms of overall macroeconomic factors. So as they say, in the storm, never take your ship out. So a lot of times, when do you raise the funds are very important. So when you're really looking at raising funds, maybe in a time where things are not looking very good, may not be the right proportion to raise funds. You probably work on your, work on your business and really and raise funds when the things are really good. Things are really good. As they always say in the markets, it's often said, you work on your best idea in a bear market or the worst of the market. Go and raise funds in a bull market. In a bull market, don't waste time really working on an idea. Go and raise funds. So the best time to really analyze, really see what can be done, how it can be done is today. I mean, today we are in a very challenging market. That's important. Obviously, then you have sector specific, and you will really have sector specific and economic specific, like how is India doing? How is your sector doing? I mean, is it affected by the lockdown? Is it not affected? Is it going to be affected, etc.? The sector specific things are also extremely, important. Now, also important is please wear the hat of an investor. When you go to an investor and you're really asking him some amount of capital, what is he looking for? He or she is looking for two things. One is security. He's looking for some kind of security. And second, what are they looking for? They're looking at returns. So what will they benchmark it to? They'll benchmark it to the listed companies. That this is, if I put X amount of money in a listed company, why should I put the same amount of money here? What is that extra bit of return that you can offer? What is that extra bit of return you will have to offer? Because today, I can go tomorrow morning and sell any amount of capital as far as the listed market is concerned. If I invest 50 crores into Reliance Industries on Monday, I can go and liquidate it. But if I put even 5 crores in a startup, there is no market because it's unlisted. I will not be able to really liquidate it. Then you really have the debt markets. Debt markets have been down and buried as far as India is concerned because of the low interest rate regime that is there. Bank fixed deposits are really the darling of investors. It's the biggest asset class that is really there. But at 5% return, no one was putting money into fixed deposits. But now what is happening is, now with the interest rate going up, anticipate it will go as high as about 6.5%, 7%. At 7%, a fixed deposit becomes lucrative again for a lot of investors. So a lot of investors that have put really money in the stock market, have made returns on the stock market, may want to really shift back to your traditional fixed deposits. Obviously, then you compete with real estate as an asset class, as it has always been the case. Now, what is it that you really have to do? You draw up your current numbers. You will have to really look at projections. Now, when you make projections, please don't make blue sky scenarios as far as Excel is concerned. When I say blue sky scenarios as far as Excel is concerned, that I have sales of 10 crores today, and after 2 years, after 1 year, I have sales of 200 crores. Not happening. You will have to really justify how are you going to reach there. You will have to go to the magnitude that how are you going to acquire the customer. You will have to justify what is the plan of acquisition, what is the cost of acquisition, how are you going to really look at it. It's not about drawing up an Excel. When you go to an investor, it is not about really showing a good Excel. It is really justifying that how are you going to really look at it. So if you have a plan that if you will do 1 crore turnover today, and probably after 1 year you will do 2 crores, that's fine. You're being conservative. You may not attract that investor. But if you go and say that I'm doing 1 crore today and I'm doing 100 crores the next year, how are you going to really attract that 100 crores turnover? What is it? What is the plan that is there? So you will have to really look at it. So look at your base year, look at the assumptions that are really there, be realistic. Okay, then look at it. Also, if you, at the initial stages, if you can invest some amount of capital from your own resources, whether it's your own family, friends, etc., It's a good avenue to really look at it. Why is it a good avenue to really look at it? For a simple reason. Dilution is less. So if I raise capital too early, I mean, my dilution will be more. Today I go and raise money at 10 crore rupees. If I raise 2 crores, I have to give 20%. But after some time, if I'm going to probably really raise 2 crores at a 50 crore valuation, it's going to be easier. So you'll have to really time, that is extremely important, that is there. Again, when you're looking at stages of investment, again, your investment could be at various stages. You could be a startup investment, you could be a mature company, you could be an early stage company, depending on what you are. But what is important that for all of you all to really understand is that you have to figure out what is the return, risk adjusted return that you're giving your investor. And whatever price and whatever maturity it is, it's like, I always look at it this way. If you invested into probably an HDFC Bank 20 years back, people still invest today as well. The story has different, times are different, returns are different. What is the risk adjusted return that is really there, that you're really looking at it? Always remember the three important aspects, especially in terms of returns, that you should really look at. One, try and ensure your gross profit margin is positive. Okay, extremely important. You may be losing money in terms of marketing spend and various other business promotion. That's fine. Try and really looking at your gross profit margin as positive. When that is positive, is something that you really give encouragement as far as the investors really concerned. Some of the hygiene factors that you will have to really look at is, you will have to look at your capital structure. As I said, when do you want to raise the capital? How much do you want to raise the capital? In what form? Should I take some kind of venture debt? Should I dilute now? When should I dilute? What do investors prefer? Investors prefer companies that show traction. When I say traction, what does it mean? You raised say 1 or 2 crore rupees, you've shown sales, you've shown your performance over a period of time, and then further gone and raised money. If you try and raise everything now, it's difficult. A lot of times what happens is, when the markets are good, a lot of promoters you meet will always say that, bazaar acha hai, sab paisa abhi utha do, that kind of thing. Then performance becomes difficult. But at every stage, if you kept raising money, and you kept really looking at it, and if you kept really looking at it, it will be a much helpful and much more beneficial real thing. Again, fundamentally look at it on your equity side, on your debt side, that is really there. Now, when you look at equity, predominantly when you're looking at equity, what is it that you really look at? You look at scalability. How are you going to really look at it? How do you really enter? What are the ways in which you enter? You will really look at it. The first thing that would really be there is, you go to an angel investor. So when you have an idea, you go to an angel investor. These are individuals that are really there, that will want to fund an idea that is really there. They will want to fund a few lakh rupees to a few crore rupees. They may do it separately, or they may really do it as a group. If they're really doing it as a group, it would really be your angel networks. Like, you have various city angel networks like Mumbai, Jaipur, Delhi, etc. Then you have what is known as professional venture capital funds. Professional venture capital funds are funds that are really registered with SEBI, Security Exchange Board of India. They have millions of dollars, and they invest into probably early stage companies. Why I say probably early stage companies is because your proof of concept is established. There is some sales, there is some kind of traction. It's just not an idea. An angel may invest at just an idea stage. You feel that this is the idea you have, you want to really look at it, you may have an angel investor. But if you want really your venture capital funds to come in, they will come at a stage where you have some kind of traction that is really there. Also, when you really look at it, very important, you will have to bootstrap. So what do you mean by bootstrap? You will have to manage your cash flow somehow. You will have to really look at it in a way where you will have to really look at it in a way you manage your company somehow. You get in some resources somewhere. The moment some cash flow comes in, some sales comes in, you will have to really manage it. So the art of bootstrapping, we can go hours and hours on how do you really bootstrap, but very simply, you will have to manage. Again, what is important is, your cash flow, that is very, very important. How will you manage your cash flow? Also, one very important thing is very important. When do you trigger your stop loss? When I say when do you trigger your stop loss, you could be a startup that is very passionate about what you're doing. It may be something very nice. You tried to raise capital probably for 1 year, you tried to raise it for 2 years, you tried to raise it for 3 years, you tried to raise for 4 years. Beyond the point, you're not getting the capital and it's not working. So someday you will have to shelf your startup and say that, listen, this is not working. Maybe you are a good startup at the wrong time. Maybe you didn't have the right team. Maybe you didn't present well, whatever be the case. So this is something that is very important, that you should have the ability to call it a day and trigger a stop loss. There have been entrepreneurs that have had 2-3 failed startups and then they have become successful. So that doesn't matter, but it's extremely important to know when you cut your loss. That is really important. When you look at your capital structuring, what's your main aim? Why do you want the capital? Do you want your capital for some R&D, IT, capital expenditure? Or are you just looking at burning? When I really say burning, what is when I say burning, what does it really mean? Your marketing and advertising, that is really, really there. Capital history is very important. When you go to an investor, they will see track record. When did you take the first investment? Was the first investor happy? As we say, was the customer happy? So your investors, you have to please your investors by performing well. That's why you see people that have raised capital once and twice, they find it very easy to raise capital. Track record is of extreme, essence that is really there. The biggest pitfalls that, just to summarize, the biggest pitfalls that you are really looking at raising capital, one is lack of patience. A lot of people think that, listen, I've started this business and in 2 months I should get capital. It may take 2 months, it may take 6 months, it may take 2 years, it may take 3 years. You will have to really be there. Insufficient planning, very, very important. As I said, that if you say that your turnover is 1 crore and you want to go to 10 crores, how are you going to 10 crores? What are the steps that you have taken? You will have to really, look at it. Very important, waiting the last moment, thinking that we don't want to dilute equity now, we'll manage it. That is how you really look at it, and in the end it becomes a real problem. Then if you really look at if you really look at it, what are you looking at? You're trying to please every funder. When you go to a funder, everyone will have a view that, listen, this is the way you should do business. Like I give you a simple example. If you have a tech company, some investor will say that, listen, you should go offline. So you say, "Okay, sir, okay, paisa de do, main offline chale jata hu." Someone will say that, no, listen, offline will not work, online will work. Sir, aap paisa de do, main online chale jata hu. It doesn't matter. What is important is what is your requirement. So you can't really keep changing a business model to please a funder, because every funder will have a different outlook. He or she is entitled to have a different outlook. But what is important is you stick to your business plan. So please don't just get persuaded to please your funder. You're not here to please him. You have to give him a return. If you give him the return, automatically you pleased your funder that is there. And obviously, the most important is not doing proper due diligence. When I said due diligence, you will have to really look at your systems, your people, etc. All of that. When you're really starting up, it's all about a journey of mistakes. The faster you learn, the better it is. If you learn from mistakes of others, the better it is. But you will have to learn. So you will have to really look at a lot of these pitfalls. Important, concluding and important, before I open it up to questions, is basically how and when you show and start up to an investor, you will have to really master that what are you really trying to pitch. There was a time for 10 or 15 years back that there were very few startups that were really there. Today, today when you're really looking at it, the amount of startups that are there are very high. The competition is high. So how do you want to showcase it? What do you want to showcase? In what way? That is really there is something that you will have to really look at. Most important, how much do you want to dilute? So what happens is when you're raising the money for a first time, okay, someone will say that, listen, I need 1 crore rupees. Okay, you take 1 crore rupees, but I will take 10%. Someone is at 20%. So please take professional help. Go to an advisor, go to an investment banker that will help you value it. Because you may feel that this is your baby and each one of us feels that our business is the best, but it may not be the case. Come down to proper expectations. That is really, that is really there. In terms of the debt, I mean, just you could look at NBFCs that are really there, non-banking finance companies that are there, that are open today to do what is known as cash flow funding. So cash flow funding is basically, say, if I am a startup and I'm providing a service to a larger company, based on the service provided, say if I am an HR company and I'm providing some service to a TCS or Infosys, based on the billings or based on my track record, they will fund my working capital. That is something that they're really looking at. And last but not the least, peer-to-peer is something that that they are really looking at. So guys, that is what I wanted to really deliberate as far as the startup ecosystem is concerned and funding. Would be happy to look at questions or answer any questions that you really have.
Yes, sir. Thank you so much for that very wonderful session. I think we have a couple of questions that have come in the chat box. First is from Ayush. He asks, what terms and key things one should think about when raising venture debt?
I mean, Ayush, to be honest, I mean, venture debt is basically a debt that will be given to companies that have probably raised a round of funding from venture capitalists or angel investors. So one, you will have to look at matching your cash flow with the venture debt. What do I mean by that? You will have repayment terms, right? That you will have to repay your debt after a period of time. What is the cash flow you are making and how are you matching that? That's the first thing. And obviously you look at cost of capital. But remember one thing, when you're an early stage company, what is important is availability of capital rather than cost of capital. What do I mean by that? Today, if you don't have capital, you will not do the business. If you have capital, even a 14, 15, 16, 17%, and if you're going to make 20, 25%, you're still making a profit. So look at cash flow and look at cost, but look at it in terms of availability versus your growth stage. That is something that you will have to look at your venture debt.
Right. The next question is from Manasi. She asks, what's the best way to run a venture debt fundraising process?
The best way to run a venture debt raising process is first raise one round of capital from probably a venture capital fund, and then really approach a venture debt fund for debt funding. That is really there. So it is in nascent stages in India, but it's really picking up. It's really picking up, that kind of thing. So.
If anybody, okay, we have one more that has come in.
Sure.
It's from Sahil. He asks, how can small business owners who work from India but sell their services in foreign companies raise funds when they are at break even? And how can they convenience their investors?
So how can small business owners who work from India but sell their services in foreign companies can raise funds when I mean to look at it this way. I mean, today when you are an exporter, either you are either you're an exporter of service or you're really exporter of goods. That is really there. So today there is a lot of impetus as far as export market is really concerned. There is a lot of credit that is given, even the banking channels as far as exporters, like pre-packing credit, export credit that is offered. So you as an exporter, if you're really looking at especially exporting of goods, I think, even the banking channel would be a good avenue to tap and to look at, even if you're an early stage company, as long as the client you're supplying to is a large company. I mean, if you're a startup and supplying to a startup, there's a problem. But if you're a startup and, like, I'll give you a simple example. I know so many IT services companies that are doing work for probably Amazon, and probably they're doing work for Warner Brothers. So I know of a company that is doing work for Warner Brothers. They have raised $10 million in debt, okay, because they're doing graphics animation for Warner Brothers. So that's export of your IT. So that can be done.
Right. Moving on, we have the next question from Shashank. He asks, can you elaborate a little bit about exit strategy of investors and promoters?
Exit strategy of investors would be really two ways. One is today what has happened in India is the listing process has become very good. You have what is known as the SME exchanges and the startup exchange as far as the Bombay Stock Exchange is concerned. So liquidity and exit can be on probably an SME platform or the startup platform, and obviously through another investor. As far as the investor is concerned, that is important. As far as the promoter is concerned, it's a wrong question of asking, my friend. I mean, as a promoter, you will never want to exit. I mean, the moment you start thinking that, boss, when will I exit? It is like, you're flying a fighter plane and you want to really, pull the parachute out. No one will give you money. So you will have to be there till your ship goes down or till your ship really reaches the shore. So I don't think so. You should be looking at exit. Obviously, there have been exits where a larger companies come and really bought you over. So in that case, it's fine. But I don't think so. You should ever do a business or get people inside your business for you to exit. You should be the last man exiting the business.
Right. The next one is from Sakshi. She says, very engaging session, sir. When we talk about big companies, how do we understand their financial gaps?
Again, Sakshi, look at the cash flow statement. I mean, the easiest, lowest hanging fruit is look at the cash flow statement. You see the biggest of companies that have failed, okay, whether you look at the Future Group or whether you look at Kingfisher Airlines or you name the company that has failed in the last decade. If you studied the cash flow statement, you knew that this is the first problem that's happening. Don't look at profit and loss means nothing. Look at cash flow statements. So for a lot of listed companies also, I keep telling investors that, don't look at profitability, look at cash flow. So please start studying cash flow statements.
Okay, the next question, sir, is from one of our respected faculty members, Chandravardhan sir. He asks how to approach VC firms, what documentation is needed.
Good evening, sir. So basically to approach VC firms, one, you will need what is known as a pitch deck or information memorandum that is really there. So basically you will have to put your pitch deck that, what is the problem you're solving? What is the team you have? What is the market you're addressing? How big is the market? What is the solution you're providing? How are you going to provide it? Why do you need the money? What do you need? So you make a pitch deck. Once you make a pitch deck, you can approach these investors. Investors would be across the board, whether they look at sector agnostic. So they look at all the sectors, or they will be sector specific. That means a few guys will only look at fintech and edtech. Someone will look at logistics, and you can take professional help of a person like an investment banker or something to really guide you on
that. Thank you, sir. With your permission, if we can take a couple of more questions.
Yeah, sure. Please go on. Yeah.
So the next one is from Arvind. He asks, what is the difference between seed funding and startup funding?
It's the same thing. It's the same thing. I mean, you put it differently. I mean, it's just I mean, there are stages of funding that are really there. It's called before proof of concept or really after proof of concept. When I say proof of concept, that means, Arvind, one fine evening sitting here, you must have got $1 million idea and someone decides to fund you. Before proof of concept, you've done nothing and you still get funding. Or probably you've done some amount of work, you've got some amount of sales. Like, we call it pre-revenue and revenue when you get funded, but it's very similar.
All right, sir. I think the last question is from Haley. She asks, is venture capital and private equity the same?
It's the same concept. Venture capitalists invest in early stage companies, private, and they will invest anywhere between, say, a few thousand dollars to probably a few $1 million. Private equity guys, they invest again in unlisted companies, but they invest in growth stage companies, matured companies. They will invest probably a few $100 million, that kind of thing. The kind of sectors that they will invest in will be manufacturing, pharmaceutical infrastructure, probably, and venture capitalists will look at tech-enabled edtech, your edtech, fintech, etc., that kind of thing.
All right. I think we're done with the questions. Sir,
so
thank
just
you
one question
for answering.
Yeah, one thing. I think Sagar has a question.
There are a lot many questions. Confusion kind of thing with students ask. Should I go with the loan kind of thing or should I go with the investor's point of view?
That's a good question. But as I always keep saying, availability of capital.
Yeah.
So let's understand one thing. In a startup, no bank is going to give you a loan. Okay, that's the very practical aspect you need to understand. You can keep going to the bank, but the bank manager will say, "Ha, wapas aao, loan nahi milega." So there's no choice but to approach an investor.
But if you get from friends or family kind of thing, bootstrapping with the loan,
if it's friends and family, again, what's your perspective? Do you want it for a short period of time? If you want it for a short period of time, take it as a loan and repay it back.
Okay.
But if you want it as long term, take it as equity or take it as investors.
Because we have got many questions like, "Arey, investors aayega, to fir exit problem hoga." Then the rules and regulation gets stringent. So what is your call on that?
No, I mean, let's put it this way: when you take money from someone, my friend, you have to answer questions.
Exactly.
I mean, the problem with early stage young entrepreneurs is basically that I know it all and don't ask me questions. Doesn't do it. You will have to answer questions. If you take money, you will have to give reports. You will have to really say why, how, when, for what. If you feel that you can't answer these questions, why, when, how, for what, then please don't take anyone's money. Then you put your own money and you go to the bank, that kind of thing.
So what should be the minimum equity kind of thing? Means someone says, "Arey, only 10% equity, I want some investors." So early stage startup entrepreneur don't know what is the value of 10%, what is the 1%. So what
to be honest, it depends on what stage you really raise.
Okay.
So the earlier you raise, there'll be more dilution. Later you raise, it will be lesser dilution. So always try and get some revenue in. ऐसा नहीं है कि idea आया और पैसा raise किया. If you go get some sales, get some client, then your dilution will be lesser. So the later you raise, but don't wait absolutely late. Don't run out of money. That kind of thing. So so ideally get a client, get some revenues, and then raise money.
Okay. Thank you, sir. Over to you, Prathamesh.
Yeah, sir. I think we just have a couple of more questions. If
sure, go on, please.
Yeah, I think you've already answered Shashank's question where he asked how much do we dilute so that we don't lose control of our company.
Shashank, to be honest, let me just answer it in a very different way. You want to be 100% owner of a 2 crore company, or you want to be a 2% owner of a 1,000 crore company? It's for you to answer, not for me to answer that. The question is, what is the value you're going to add? You can say that, boss, I'm 100% owner of your company, but your company is worth 2 crore rupees. Or you can say, boss, I'm 2% owner in this company, but this company is worth 1,000 crores. That's a question you need to answer. So again, growth, how are you going to really look at? Percentage doesn't matter. Are you going to grow this company, or are you not going to grow this company? That is important.
Right. And I think we just have one more question from another respected faculty of ours, Amay sir. He asks, sir, what criteria is used to analyze an early stage startup as compared to a late stage startup?
Again, sir, if you really look at it, I think first thing is, pre-revenue or post-revenue. So, if you're just saying early stage startup, assuming it's a pre-revenue stage, so then the most important thing that people will judge is the capability of the promoters or the people that are really backing the venture that is really there. Because at the end of the day, what you are backing pre-revenue is basically you're investing into the people rather than the concept. But if it is a mature startup, then there are various ways to look at it. What is your traction you've got? What is the kind of conversions you've had? What is the kind of run rate you've got? What is the bleed rate you had? There are various matrices. But if it's pre-revenue, it's just like, I like this guy and let's give him money. As simple as that, that kind of thing. That is why we see that, what happens is when we see promoters that have raised money in the past, they are able to raise money again and again very fast. So you may shut down this venture and go to a next venture, but because you have track record, people believe in you. That kind of thing. That's how it is.
All right. I think we're done with the questions. Thank you, sir, for actually patiently answering all our questions. I will now hand it over to Nausheen for the formal vote of thanks.
Sure.
Good evening, everyone. On behalf of B-School, I would like to take this opportunity to express gratitude and thank Mr. Farzan Ghadially, sir, for sharing his thoughts and technical insights about venture capital funding. The webinar was, in the truest sense, enlightening and has provided us more clarity about startups and venture capital funding in and out. It was indeed an enriching experience, sir. We thank you for your time and insights. I would also like to thank Professor Dr. Kaustubh Dharkalkar, sir, for inviting Farzan, sir. Also, thanks to the entire organizing team for putting up such an informative session. Last but not the least, I would like to thank all the students for being patient listeners and active participants throughout the session. Good night, everyone. Thank you.
Thank you so much. Thank you so much. All the best. And hopefully some of you students will make the next unicorn. Thank you. Good luck.
Thank you, sir.
Thank you, sir. Thank you so much.
Thank you, sir.